Hello everyone, let's get started. The first interesting topic I want to talk about is the misprice in momentum strategy. There are two main articles in it. The first one is the overpriced winner, and the second one is momentum has its moments. Let's talk about the first article first. There are one assumption and one background knowledge before we go into the article. It assumes that there is a passive investor demand stocks regardless of price, and we have to know that when you want to short sell, you need to borrow, and when the demand for stocks did not exceed institutions holding, competition will appear between institutions and drive the cost to zero. Otherwise, a high cost will be caused by investors. Given this, let's go into the process why the overprice will occur. At first, there's a large divergence of opinions between investors. A large divergence of opinions means that the optimistic investors become more optimistic about the stock, and pessimistic investors become more pessimistic about the stock. As a result, a large change of demand for the stock happens. When a large change of stock happens, the demand for stock exceeds the institutional holdings, and thus leading to a high trading cost. And a high trading cost, by the model, the author tells us that it will lead to overpriced. And the main question is how to identify large divergence of opinions. The author told us that the predictor for large divergence of opinions is large past returns and short sell change. When there's a large change in past return and short interest, there is a large divergence of opinions. And the high trading cost is correlated with institutional lending, volatility of the risk, and risk aversion of the arbitrager. However, what we can observe is only the institutional lending, so we are focused on the institutional lending. We use the institutional lending to identify the high trading cost. The firms with low institutional trading is likely to have a high trading cost, since we've announced before, a firm with low institutional lending, when you demand for the firm's stock, is easily to exceed the institutional holding and leading to a high trading cost. And given this, the author create a bet against winner portfolio. That means buy past winners and short past constrained winners. And this portfolio did earn abnormal returns. Constrained winners means the winner we've talked about before. It has a large divergence of opinions and firms with high trading cost. That means the core has experienced a last past return and short interest change. However, it is also have a low institutional lending. These firms are considered constrained winners. However, there is also one parcel in this portfolio is what kind of shocks cause divergence of opinions is still unknown. Okay, let's get into the second article. The second article is momentum has its moments. The the empirical results show that momentum portfolio has a reversal in the long run. And there's a strong relationship between the PMP and the stale momentum portfolio. Given this, we construct a portfolio that buys stale winners and sells stale losers, and we found that this portfolio did earn abnormal return, and then we go into deeply find the explanation for this phenomenon. And the possible explanation for this may be style tracing, and it is found that institutional did follow style tracing. Style tracing means that when you observe the momentum strategy did earn abnormal return, and the momentum portfolio has a high past performance return, and you follow the momentum strategy. You buy winners and sell losers. And however, given this, there's a main challenge to this idea is that the reversal comes too late. If the phenomenon is caused by style tracing, investors will correct their views about the stocks in one fiscal year, since the announcement will happen in one fiscal year. However, the reversal time comes too late. It comes, as we've discussed, it comes 2 to 5 years. It's more than 1 year. So that remains a puzzle. And to compare this article, we find that their focus are different. And the first one focused on the short time, and the second one focused on the long time, 2 to 5 years. However, they all focus on the overprice. Okay, let's talk about the second one, institutional process and firm complexity. And the two main articles are complicated firms and firm complexity and post-earning announcement drift. And the complicated firm argue that more complex firms need more time to react to information. And to test this argument, the author first construct a pseudo-conglomerate portfolio weighted by sale. For example, you have a firm consisted of two segments, and you weighted these two segments by their sales. That's the portfolio. And empirical findings are that firms have significant predictable abnormal returns from their paired pseudo-conglomerate portfolio and are complex firms. In another word, only complex firms have significant predictable abnormal returns from their paired pseudo-conglomerate portfolios. The author also exclude other cause of this phenomenon, such as industry-wide continuation. And it is found that the less complexity the firm is, the weaker the paired pseudo-conglomerate can predict future return. However, it is worth noticing that no significant loading on the previous 5 factors, small minus big, high minus low, liquid, market, and momentum, indicating there is a new anomaly in the capital market. Let's turn to the second one. First, complexity and post-earning announcement drift. The author finds that complex firms have relatively large PEAD than simple firms. The The reason behind this may be business complexity induced information friction and make it more difficult to understand. And the author also finds that complex firms are more difficult to understand and result in a low institutional ownership and are covered by fewer analysts and specialists. And by empirical finding, it is clear that degree of complexity have a positive relationship with PEAD. The more complex the firm is, the larger the PEAD of the firm is. And let's compare and contrast these two articles. While these two articles all focus on the information process and the complexity of the firm, and they study in quite different focuses. The second article also found that complex firms are covered by fewer specialists and analysts. Using a graph to illustrate this is that different information process is caused by the two reasons. The first is the complexity in the firm makes it difficult to understand, and the second one is the complexity firms are covered by fewer analysts and specialists, and the complexity of difficult to analyze also is a reason for why the complex firms are covered by fewer analysts and specialists. Thanks for listening.